Hi, so this is a video version of the PowerPoint for Chapter 14. Okay, so this is going to be for the entire chapter, and there are a total of 3 different sections to this chapter, and we're all going to take care of them today. Okay, so we're going to start with 14.1, which is uncollectible accounts receivable, and the three objectives that we're going to go through today are explaining the purpose of the allowance method for recording losses from uncollectible accounts. Okay, the second one is to estimate uncollectible accounts expense using an aging of accounts receivable. Third objective of this section is to record the adjusting entry for the allowance for uncollectible accounts. Okay, allowance method of recording losses from uncollectible accounts. We have some vocabulary here. Let's start with uncollectible accounts. These are accounts receivable that cannot be collected. Bad debts means some businesses refer to these uncollectible accounts using that, bad debts. Crediting the estimated value of uncollectible accounts to a contra account is called the allowance method of recording losses from uncollectible accounts. More on that. Book value is the difference between an asset's account balance and its related contra account balance. Okay. The book value of accounts receivable is the difference between the balance of accounts receivable and its contra account allowance for uncollectible accounts. Okay. And the net realizable value is the amount of accounts receivable a business expects to collect. That's expected, not necessarily what it has collected or what it will collect. It's the expectation. Okay. Two methods are commonly used to estimate uncollectible accounts receivable. They are the percent of sales method, which assumes that a percent of credit sales will become uncollectible, and the percent of accounts receivable method, which uses an analysis of accounts receivable to estimate the amount that will be uncollectible. The aging of accounts receivable is analyzing accounts receivable according to when they are due. That's aging of accounts receivable, analyzing accounts receivable according to when they are due. Now, this is an example of what this would look like. And the steps. The first thing you would want to do is compute the estimate for each age group. And then you want to compute the total estimate. And then you want to compute the addition to the allowance account. Okay. So, looks like all of the uncollectibles will be added together, and that'll give you the 2,509.25. And then you would subtract the 125.15, which is the current balance of allowance for uncollectible accounts, and that'll give you 2,384.10, which is estimated addition to allowance for uncollectible accounts. Okay, adjusting entry for allowance for uncollectible accounts. This is how it will look. Uncollectible accounts would be adjusted by 2,384.10. And then the allowance for uncollectible accounts will be increased in the balance by 125.15 and adjusted by 2,384.10 for the new balance of those two put together, 2,509.25. And then for the general journal, this is how you would mark everything. You would write adjusting entries. the date, the account title, which is uncollectible accounts expense, the debit amount, the account title, and then the credit amount. Okay, and they're going to equal everything. In this case, 2,384.10. We're just about at the end of section 1. So here are the end of section review questions. So what general ledger accounts are used to account for uncollectible accounts receivable? These are the contra asset account allowance for uncollectible accounts and the expense account uncollectible action accounts expense. Explain why an adjustment for uncollectible accounts is an application of the matching expenses with revenue concept. And the allowance method of recording losses from uncollectible accounts attempts to match the expense of uncollectible accounts in the same fiscal year that the related sales are recorded. And what are the two methods used to estimate uncollectible accounts receivable? Percent of sales method and the percent of accounts receivable method. Last one for this section. How is accounts receivable affected by the estimate of uncollectible accounts? And the account is not affected. No effect there. Okay, now we're in section 2 of chapter 14, which is writing off and collecting uncollectible accounts receivable. So the objectives of this section are to write off an uncollectible account receivable and account for the collection of an account receivable that was written off. Okay, journalizing the writing off of an uncollectible account receivable. So here we have the definition of writing off an account, and this means canceling the balance of a customer account because the customer doesn't pay. Okay, sometimes this happens, but it's just a matter of business. Now here's how it would look if we're journalizing a statement. Okay, so now everything's loaded. January 25th. Wrote off Edmonds Hospital's past due account is uncollectible in the amount of $639.88. This is memo number 58. Okay, in the general ledger, this is how you would write it. In the allowance for uncollectible accounts, date January 25th, down $639.88. On the right-hand side of the T account, new balance would be $1,869.37, which is the difference of $639.88 and the balance. Then the accounts receivable, the new balance on the left-hand side would be $21,203.27. Okay, which you can see is just the difference between that, between the $639.88 and the starting balance. And then to make everything equal, then the right-hand side will go down by $639.88. Accounts receivable ledger for Edmonds Hospital, this is how it will look. New balance of 0, it means that it's canceled. And January 25th, right-hand side, $639.88. Okay, this is how you would look in the general journal. Make sure that all of these are included. The date happened on January 25th. The account titles, allowance for uncollectible accounts. The memo number is right underneath the doc number. The debit amount. Okay, and then we're going to move on to the next line. The account title and customer name, accounts receivable of Edmonds Hospital. And then just remember this, underneath the post ref, there's a diagonal line, and the credit amount will be the same as the debit amount in the previous line. Okay, posting an entry to write off in uncollectible account receivable. So, date, write written off, The journal page number will all be the same. Okay. G for general journal, page 16. Debit or credit amounts. Okay, and these are $639.88. The account balance. And then only over there, you see where that was that diagonal before, and you write the account number. Okay. 1,130, 1130, and then 120, which is the customer account. Here's another example. On March 9th, received cash in full payment of Edmonds Hospital's account previously written off as uncollectible for $639.88. And this is memo number 71 and receipt number 695. Okay, so now we have the T account starting with the general ledger. March 9th, we'll have the balance of $639.88. Okay. So the new balance will be $21,843.15. Okay, $639.88 is written on the other side of the T account for accounts receivable. Allowance for uncollectible accounts. The new balance is $2,509.25. And then accounts receivable ledger for Edmonds Hospital, the new balance is $639.88. That's if you're reopening it. Okay. Very similar to before. Make sure you have the date, the account title and customer name, the memo number, the diagonal line underneath post reference, the debit amount in the first line, and then next line, the account title, and the credit amount, which will be the same as the debit amount in the last line. Okay, so we can take a look at this. March 9th, received cash in full payment of Edmonds Hospital's account, previously written off as uncollectible, $639.88, memo number 71, and receipt number 695. General ledger will go up $639.88. Next T account, accounts receivable, will go down by $639.88. Okay. T account for accounts receivable ledger will have a new balance of 0, and then the accounts receivable will be changed by $639.88. Okay, and for this one, this is how we would write it in the cash receipts journal. Make sure you have the date, customer name, receipt number, the amount to credit, and write that underneath the accounts receivable credit, and then debit. Cash debit. Posting entries for collecting a written off account receivable. Want to first post the general journal entry to the general ledger. Then want to post the debit portion of the general journal entry to the customer account. Then you want to write the words reopen account in the item column of the customer account. And then post the cash receipts journal entry to the customer account. Number 4. We're on to the review part of section 2 of chapter 14. Why is allowance for uncollectible accounts debited when a customer account is written off? The balance of the customer account is an actual uncollectible amount and no longer an estimate of an uncollectible amount. Does the book value of accounts receivable differ before and after writing off an account? Explain. The book value is the same because the same amount is deducted from the accounts receivable and the allowance accounts. And last review question. Why is a customer account reopened when the account is paid after being previously written off? And this is to show an accurate credit history. Now we're on the third and final section of Chapter 14, promissory notes. So you might even know promissory notes from the legal sense, which are just ways for people to borrow money and for the agreement to be understood by both parties, meaning that it could be enforced by a court if it comes to it. So this is looking at it from the accounting perspective. Okay, so the objectives of Chapter 14, Section 3 are to learn how to record the acceptance of a note receivable, account for the collection of a note receivable, account for a dishonored note receivable. Understanding promissory notes. Here we have some definitions. Promissory note is a written and signed promise to pay a sum of money at a specific time. And there might be some other terms on this too, but it's basically saying that I will pay ABC company back by August 1st of 2020, or whatever the date may be. Okay. Creditor is the person or business to whom a liability is owed. So if I'm saying that I'm going to pay it to ABC company, then ABC company is the creditor. A note payable is a promissory note signed by a business and given to a creditor that is entered into the business's books. Note receivable, on the other hand, is a promissory note that a business accepts from a customer and is entered in the business's books. Okay, so I would have a note payable to ABC company and they would have a note receivable from me. Notes are notes payable and notes receivable, and they're just referred to as that to make it faster. Maker of a note is the person or business that signs a note and payment. A payee is the person or business to whom the amount of a note is payable. Okay. Principal is the original amount of a note, sometimes called the face amount. Interest rate is the percent of the principal that is due for the use of the funds secured by a note. Maturity date is the date on which the principal of a note is due to be repaid. Time of a note, aka term, is the length of time from the signing date to the maturity date, and is usually discussed in days. So this is an example of what an old school form promissory note would look like. And these are the different components to it. You would have the number assigned to the note, the date the note was signed, the payee. I'm just going clockwise here. Maturity date, the witness, the maker of the note, the interest rate, the principal, and the time of the note. So this is an example of a transaction that involves accepting a note receivable from a customer. March 18th, accepted a 90-day 8% note from Skinner College for an extension of time on its account in the amount of $2,578.35. This is note receivable number 6. So in the general ledger, Notes receivable would go up by $2,578.35, and then accounts receivable would go down by $2,578.35. Okay, accounts receivable ledger will go down by $2,578.35. Okay, this is how it would look in the general journal. So here we have the steps. First, we're going to make sure that we have the date, then the account title, same line underneath doc number. We have note receivable 6, so we're going to call it NR6. Okay, then we have the debit amount, and then we're going to go on to the next line, and that will be starting with account title and customer name. Then we'll make our diagonal line, and then we'll write or type our credit amount, which is the same as the debit last line. So now we're going to get into a little bit about interest on promissory notes. So interest is the amount paid for the use of money for a period of time. Okay, so here's an example of how it would look. There is principal or face value, which is the amount a person or company borrowed at $2,578.35. Okay, and then we would multiply that by an annual interest rate, which has been set. Okay, and that would be at 8%. For example, that's what was agreed upon. Okay, time is fraction of a year, and we're going to use a year as the accounting equivalent of 360 days. Okay, and then we're going to multiply those three things together: principal, annual interest rate, and time as a fraction of a year, and we'll get interest for that part of the year. That quarter of a year, 90 divided by 360 is a quarter of 51.57. Maturity value is the amount due on the maturity date of a note, and that will just be the principal plus the interest to equal the maturity value. Maturity value. Okay, so principal face value plus the interest, that'll give us $2,629.92. Okay, maturity date of promissory notes. So this just gives you a timeline for all of them. Number of dates of the first month, which would be 13 from March 18th through March 31st. Then days remaining after this month, which will be 47. Lesser of the days of the month and the days remaining after the previous month. And days remaining for the last. Okay, so just keep track of your days. Collecting principal and interest on a note receivable. When a note receivable reaches its maturity date, the maker of the note is expected to pay the maturity value to the payee. Interest income is the interest earned on money loaned. The interest earned on a note receivable is credited to a revenue account titled interest income. Okay. So here's an example of a transaction and the T accounts. June 16th, received cash for the maturity value of notes receivable number 6, a 90-day 8% note with principal of $2,578.35 plus interest. That'll be $51.57 total, and ultimately total of everything, which is the principal plus interest of $2,629.92, and this is evident from receipt number 782. Okay, so cash would go up by $2,629.92. Notes receivable would decrease by $2,578.35, okay, which does not include the interest, and then the interest income will increase $51.57. Okay, this is how it looks in the cash receipts journal. Date, account title, receipt number, all from the transaction, principal amount from the transaction. Second line, interest income is the account title, interest amount straight from the transaction, and credit amount will just be the total. Okay. Recording a dishonored note receivable. The vocabulary word here, dishonored note is note not paid when due. Another transaction with the T accounts. June 3rd, Style Company dishonored note receivable number 4, which is a 60-day 8% note, and the maturity value is due today of principal of $3,000, interest of $40, and a complete total of $3,040, all mentioned in memo number 98. Okay, so the account receivable will go up by that much. Note receivable will go down by $3,000, and then the notes receivable in another line will go up by $40. Okay, the accounts receivable ledger will just go up by $3,040. General journal, date, account title, customer name, and amount. Memo number underneath doc number. Diagonal line under post ref. Then you would have the debit. And then on the next line, notes receivable, account title, and principal amount. Line after that, account title and income amount. Those are credited. Now we're at the review questions. So, what condition might cause a business to delay payment to a vendor? Okay, so right now, as the coronavirus is happening, this is an example of that. So, the book's answer, similar, very general, is the receipt of cash from sales does not occur at the same time and in amounts sufficient to pay for needed purchases and expenses. So in other words, your cash flow is too low that you can't pay for your expenses at that time. What's the advantage of a promissory note over an account receivable? Okay, so as I mentioned earlier, it would be legally binding. So a note can be useful in a court of law as written evidence of a debt. Okay, what does an interest rate of 10% mean? So 10% of 100 is 10. Okay, 10% interest of 200 is 20, etc. So book's answer is 10 cents paid on every dollar. And that's assuming for a full year. Okay, now, what is written in a customer's account when first condition, a note is accepted, and second condition, a note is dishonored? The words accepted note and dishonored note are written in the item column of the customer's account. Okay, so that's everything for Chapter 14, done in a little less than half an hour. Any questions on this, please let me know. Thank you.